Good debt versus bad debt. What you must know. Hi guys, welcome back to the channel. In today's video, we're going to talk about good debt versus bad debt. What is it? Which one should you go for? What are the things that you must know? So if these questions are answered by the end of this video, I'm sure you will have a very clear picture about it. Let's first start with what is good debt. Good debt is basically when you were borrowing money to buy something that will either A, make more money for you, or B, increase in value over time. The most common example of good debt is when you take a mortgage to buy a house. Now, the house is an asset, something that can either remain the same in value or increase in value over time. And secondly, you're taking out a loan which is tax deductible. So you get to reduce your taxable income by the amount of interest that you're repaying on that loan. So this is a classic example of good debt. Other examples include land, which is an asset, or a business, which can make money for you. Bad debt, on the other hand, is when you're reborrowing money to buy something that does not make money or does not increase in value over time. Classic examples of bad debt are credit card debt, personal loans, payday loans, and car loans. These are all debts that do not make any money for you, and in most cases actually decrease in value over time. So here are 5 things that you must know about good debt versus bad debt. Number 1, with good debt, the interest that you're paying on that debt is tax deductible. With bad debt, the interest that you're paying is not tax deductible. And in most cases, that interest rate is much higher because it's unsecured debt. So that is point number 1. Point number 2, with good debt, you're buying an asset that either makes money or increases in value over time. With bad debt, you're buying a liability that decreases in value over time. So the asset side is that you're buying an asset, whereas on the liability side, you're buying a liability. Point number 3, with good debt, you can normally get tax benefits, whereas with bad debt, there are no tax benefits. Point number 4, with good debt, you have a fixed repayment schedule, and you know exactly how much you are going to pay over the life of the loan. With bad debt, you only know how much your minimum payment is going to be. But the reality is that you could end up paying double or even more than double what you originally borrowed, if you do and pay it off on time. So that is another big difference. And the last point, number 5, with good debt, it normally comes with a longer repayment period. For example, if you buy a house, you probably finance it over 25-30 years. On the other hand, bad debt normally comes with a shorter repayment period. Credit card debt, for example, you're expected to pay that off within a month. If you don't, then you're going to be charged interest. I hope that was helpful. Let me know if you have any questions. I'm here to help you become financially free as soon as possible. So please subscribe, and I'll see you in the next video.